Chris Burniske, Cryptoassets, the Innovative Investor's Guide to Bitcoin and Beyond. Enter the world of cryptoassets, a realm where digital innovations such as Bitcoin introduce groundbreaking opportunities for investors. By delving into Cryptoassets, the Innovative Investor's Guide to Bitcoin and Beyond, you can explore these digital commodities and learn the ins and outs of this technology. Designed for people between the ages of 20 and 40, this summary will guide you through the history of Bitcoin, how blockchain technology works, the vast array of cryptoassets available, and how to invest wisely in this arena. Discover the correlations between traditional investments and cryptoassets, and unlock the key to evaluating potential risks and rewards in this exciting world.
Cryptoassets, unveiling their worth. Cryptoassets, such as Bitcoin, are a unique blend of digital commodities consisting of software and currency. Their value is determined by market supply and demand, and they don't fit into a single existing asset class. For instance, Bitcoin's software aspect works similarly to consumable/transformable assets like oil, while its currency component is comparable to store-of-value assets like gold. Successful cryptocurrencies will be both useful and serve as a store of value, making them attractive to today's investors. By now, you've probably heard of Bitcoin and a few other cryptocurrencies. These digital commodities, called cryptoassets, present exciting new opportunities for both seasoned and amateur investors. So what exactly constitutes a cryptoasset? In simple terms, it's a commodity that includes software and a related digital currency. The value of cryptoassets, like other commodities such as gold and oil, relies partly on market supply and demand. However, unlike tangible resources like gold and oil, cryptoassets are intangible. Their value stems from the software they represent rather than any physical resource. Let's use Bitcoin as an example to understand how this dynamic works. Bitcoin encompasses both software and an associated currency, making it difficult to classify within a single asset class. Comparing Bitcoin to oil reveals some similarities. Oil is known as a consumable/transformable asset, typically purchased to create other products. Likewise, Bitcoin's software can be utilized for various purposes. On the other hand, Bitcoin's currency component resembles another asset, gold, a store-of-value asset. Gold is valued for its rarity, beauty, and usefulness, and its worth has been internationally recognized. Cryptoassets like Bitcoin operate similarly. They're finite and valuable, much like gold but without government-backed currencies. Many people invest in Bitcoin without intentions of trading, letting it appreciate in value over time, akin to gold and other precious metals. The successful cryptocurrencies will be those that are practical and function as a store of value. Though cryptoassets don't easily fall into pre-existing asset classes, their versatility makes them even more attractive and valuable for modern investors. Unraveling the blockchain magic. Blockchain technology, the backbone of cryptoassets like Bitcoin, is a decentralized, digital database that records ownership details. Its properties include being distributed, cryptographic, immutable, and ever-growing. With transactions recorded and added as new blocks by competing miners, it's nearly impossible for underhand dealings to remain unnoticed or to tamper with the blockchain, making it secure and transparent. Understanding the magic behind blockchain technology can seem daunting, but it's actually a fascinating and secure system that's revolutionizing the world of digital transactions. When dealing with cryptoassets such as Bitcoin, it's essential to know that blockchain is the powerhouse that keeps everything running smoothly. Imagine a colossal digital database that tracks who owns what. That's precisely what a blockchain does. Unlike bank databases or centralized government systems, blockchains are decentralized and operated by millions of people who run the relevant software on their computers. If you were to download Bitcoin's software, you'd be playing a role in supporting a system with several vital properties. Firstly, blockchain is distributed, allowing any computer to access it publicly. Secondly, it's cryptographic, which means all data has unbreakable computer-generated encryption. Thirdly, it's immutable. Information cannot be deleted from the system, as the database continuously syncs with personal computers across the globe. Lastly, blockchain is always growing, with new transactions and data regularly added. Transactions, or blocks, are documented and contributed to the blockchain database by computers called miners. These miners compete to record transactions within the system quickly, receiving payment in Bitcoin when they successfully add a new block. Blockchain's decentralized nature ensures a high level of security and transparency. Tampering with data or fraudulent transactions is virtually impossible since any modification demands unanimous approval from all software users. Transactions are verified by each synced blockchain database, thwarting any attempts at cover-ups or underhanded actions. If someone tried to make an illicit transfer, the databases would fail to sync, and the wrongdoing would be unmasked. In a world where trust is paramount, blockchain technology redefines security and transparency, revolutionizing the way we approach digital assets and transactions. Exploring cryptoassets beyond Bitcoin. Bitcoin, the first and most famous cryptoasset, was introduced on Halloween 2008, following the financial crisis. Its inventor, Satoshi Nakamoto, remains a mysterious figure. While Bitcoin was designed as a decentralized currency relying on mathematical proof, it isn't the only cryptoasset on the market. Ethereum, for example, uses its blockchain for collaborative creation and distribution of open-source software, with its native asset being called Ether. Other cryptoassets, like Monero and Zcash, utilize private blockchains requiring special permissions for access. Financial services often prefer private blockchains to maintain privacy while leveraging blockchain technology's efficiency. Unraveling the enigma of Bitcoin's birth, we find that the digital currency came into the world on October 31st, in the aftermath of the 2008 financial crisis. The intention behind Bitcoin's creation was to offer a decentralized alternative to the traditional financial system, based on mathematical proof instead of trust. The identity of Bitcoin's creator, Satoshi Nakamoto, remains shrouded in mystery, with some speculating that the name refers to a group of collaboration rather than an individual. The global frustration with the financial system after the crisis paved the way for Bitcoin's acceptance, skyrocketing it to fame over the last decade. However, Bitcoin is not the sole holder of the cryptoasset throne. Other innovative digital assets have emerged, carving their own niches and offering unique functionalities. One notable example is Ethereum, which has expanded the scope of blockchain technology. Unlike Bitcoin, Ethereum's blockchain caters to the collaborative creation and distribution of open-source software. Its native digital currency, Ether, powers these operations. While both Bitcoin and Ethereum have public blockchains, some cryptoassets prefer to keep their blockchains private. Monero and Zcash are examples of digital currencies that employ private blockchains, restricting access to only those with special permissions. This approach is particularly appealing to financial services institutions, as it provides the benefits of blockchain technology's efficiency while ensuring the privacy of their financial transactions. As the world of cryptoassets continues to evolve, it's crucial to stay informed and explore the various options available beyond Bitcoin. Seize the cryptoasset opportunity. Stock market investments can be daunting, but cryptoassets like Bitcoin offer a safer and promising alternative. Blockchain technology has the potential to revolutionize the financial world like email did for communication. While Bitcoin is still in its early stages, its value and popularity are expected to grow consistently. However, other younger cryptoassets like Ethereum remain volatile until they establish a dependable foundation. It's essential to understand the risks before investing to make the most of this emerging opportunity instead of merely gambling with your money. Navigating cryptoasset dangers. Cryptoasset investing presents potential dangers, such as the speculation of crowds problem and the "this time it's different" mentality. The first danger is when amateur speculators see others investing and jump on the bandwagon without truly understanding the worth of the asset. This can lead to substantial losses if the cryptoasset fails or the professional speculators sell. The second danger lies in thinking that cryptoassets are so different from traditional assets that common sense doesn't apply. While they are different, it's essential to recognize their unique features and make informed decisions to reap their massive potential benefits while mitigating risks. When investing in cryptoassets, it's crucial to be aware of the dangers in order to protect your hard-earned money. One significant danger is the speculation of crowds problem, or the monkey see, monkey do effect. This occurs when numerous amateur speculators start investing following others' actions, not truly understanding the worth of the asset or the rationale behind their investment. Should the cryptoasset fail or professional speculators sell, these amateurs can face significant financial losses. Another peril is the belief that, this time it's different. This mindset convinces people that this time around, markets have learned from past mistakes, and cryptoassets are so unique that old rules don't apply. While it is true that cryptoassets are distinct from traditional assets, it doesn't imply that common sense should be abandoned. It might be challenging to assign a value to these assets due to their novelty, but reliable methods do exist for determining their underlying value. Informed investors recognize the vast financial and other benefits that cryptoassets can offer. However, they also remain mindful of the potential risks associated with investing in this innovative asset class. By understanding the dangers and maintaining a balanced perspective, it is possible to navigate the cryptoasset sphere effectively while minimizing risks. Mastering correlation and diversification. In building a strong investment portfolio, it's crucial to understand the concepts of correlation and diversification. By combining assets like stocks and bonds that react differently to market shifts, and adding cryptoassets to the mix, you create a diverse investment strategy ready to weather any economic storm. Diving into the world of investing, it's essential to have two core principles in mind when structuring an investment portfolio: correlation and diversification. The key to a healthy portfolio lies in having various assets that work together, complementing each other and reacting differently to market fluctuations. It's no secret that distinct assets don't respond to economic events in the same manner. For example, stocks and bonds have different reactions to the health of an economy. In a thriving economy, stock prices soar while bond prices slump because investors prefer the excitement of stocks to the safety of bonds. The concept of correlation quantifies the degree to which one asset's reaction deviates from another. Stocks and bonds exhibit a negative correlation, meaning they respond in opposite ways to economic events. Though desirable, an even better correlation is zero correlation, which occurs when an economic event affects one asset, leaving the others untouched. Diversification is where the magic happens. By building a portfolio comprising both stocks and bonds, you pave the way for a sound investment strategy that can withstand economic highs and lows. However, positive correlation is a pitfall to avoid. It's the equivalent of putting all your eggs in one basket, with all assets responding in the same way to economic events. Cryptoassets hold the key to avoiding positive correlation and minimizing overall risk because they make diversification more manageable. Suppose you already possess a stocks and bonds portfolio. In that case, incorporating cryptoassets can further diversify your investments, shielding you against traditional market failures that barely impact cryptocurrencies. Thus, securing a winning investment strategy, regardless of the stock market's fate. Cryptoassets, smart buying tips. Feeling excited about dipping your toes into the world of cryptoassets? Hold up. It's essential to familiarize yourself with exchange platforms, such as Bitstamp or GDAX, in order to open an account for trading. Major cryptocurrencies like Ether and Bitcoin can be bought with fiat currencies, or in some cases other cryptocurrencies. Purchasing other cryptoassets is generally done using these major currencies. The beauty of cryptocurrencies lies in their fast, internet-based transfers, making them more convenient than traditional currencies. But remember, though, to evaluate the strength of a currency before investing by checking its trading pair diversity. A larger number of pairs signifies a more reliable cryptoasset, especially when paired with fiat currencies. CryptoCompare is a helpful resource for gauging these pairs. In a nutshell, don't let the frenzy cloud your judgment. Be well informed and cautious while entering the crypto market. Balancing crypto storage options. You've acquired your first cryptoasset, and now it's time to figure out how to securely store it. The key lies in choosing between hot wallets and cold storage, each with its own set of advantages and disadvantages. Hot wallets offer easy access but less protection, while cold storage provides increased security but requires extra effort to access your assets. Crypto exchanges offer a mix of both, but make sure to choose a reputable platform with proven safe storage systems to safeguard your digital wealth. Congratulations on entering the world of cryptoassets. Now, the big question is, how can you securely store your newly acquired treasure? It all comes down to safeguarding your private key, which allows for transferring your cryptoasset to others. There are two storage methods to choose from. Firstly, hot wallets store your private key online, either in the cloud or on a connected device. This option grants you the ease of accessibility and quick transactions. However, they are vulnerable to cyber attacks and hacking incidents. On the other hand, cold storage refers to offline storage of your private key. Examples include keeping it on a pin-protected hard drive or physically writing it down and storing it in a secure location. Cold storage offers improved security, as hackers cannot acquire your private key without physically obtaining your storage device. The trade-off is that it can be more challenging to access your assets as quickly and conveniently as with hot wallets. Crypto exchanges often provide a blend of hot wallet and cold storage options, delegating the protection of your private key to a trusted third party. Coinbase is a popular choice, offering both hot wallets and protected cold storage. While many platforms claim secure storage, not all are created equal. Some exchanges store more assets in hot wallets, making them more susceptible to hacks. Make sure to thoroughly research your chosen exchange and its storage system to ensure the safety of your cryptoassets. In the end, the best storage method is the one that balances accessibility and security to meet your individual needs. Evaluating cryptoassets, a guide. To become a savvy cryptoasset investor, you need to thoroughly assess each potential investment. Start by reviewing the white paper, which outlines the cryptoasset's purpose, functionality, and competitive edge. Ensure it is clear, specific, and error-free. Next, look at the decentralization edge or its unique proposition as a decentralized service. Assess the community support and developer competence behind the cryptoasset. Lastly, examine the issuance model, which should be fair and transparent. Avoid cryptoassets with excessive initial supply, as this might lead to low value due to market saturation. Imagine you've dipped your toes into the world of cryptoassets, but you're unsure about assessing the risk of new investments. Innovators in this field don't just skim valuations, they dive deep into white papers and decentralization edge. The white paper serves as the cornerstone for understanding a cryptoasset. It should clearly outline the project's aims, how it intends to solve issues with other cryptoassets, its competitive advantages, and functionality. Keep an eye out for clarity, accuracy, and comprehensibility, any vagueness, errors, or obscurity signal red flags. A cryptoasset's decentralization edge refers to its unique value as a decentralized service. Consider Swarm City, an app built on Ethereum, that empowers users to set up businesses, transact peer-to-peer, without intermediaries like Airbnb and Uber. Additionally, innovative investors focus on three key factors: community, developers, and issuance model. Trustworthy cryptoassets boast supportive communities, engaged investors or miners, and competent developers. It's essential that those involved have the relevant experience and dedication to the project. A reasonable issuance model is also crucial. This model delineates native asset distribution, the total currency distribution, miners and developers involved, and their share in the currency. Stay wary of issuance models favoring miners and developers excessively, as this could lead to a centralized power dynamic, placing other investors at risk. Finally, take note of the initial supply. If it's too high, market oversaturation could prevent the cryptoasset's value from rising. In conclusion, successful investment in cryptoassets comes down to diligent evaluation and informed decision-making. The rest, as they say, is up to you.
After exploring the world of cryptoassets and blockchain technology, you should now have a deeper understanding of its significance and potential. From the mysterious birth of Bitcoin to the diverse applicability of blockchain, cryptoassets offer a unique investment opportunity, storing value while providing new functionality. By understanding the intricacies of investing in these digital commodities and avoiding the common pitfalls associated with speculation, you can make informed decisions and build a diverse, resilient portfolio. As the world of cryptoassets continues to evolve, stay vigilant and prepare to adapt to this dynamic landscape, ensuring you benefit from the countless possibilities it has to offer.